pessoal da Investmart aí, primeiro, bem-vindos a todos aí mais um SmartCast. Hoje a gente tem presenças aí magníficas, numa linguagem agora diferente, tá? First, I would like to thank David, Wayne, and Bernardo. David and Wayne from Oaktree, and Bernardo from Gama. Guys, please, please introduce yourself so we can later talk about the scenario and stuff.
Sure. So I'm David Rosenberg. I've been at Oaktree almost 20 years now and co-manage our high yield and our global credit or multi-strategy products.
I'm Wayne Dow. I've been at Oaktree for almost 7 years and work with David within our multi-strategy credit portfolio.
My name is Bernardo Gama. I'm responsible for the Gama Investimento. Gama is the partner of Oaktree here in Brazil that will have the feeder funds to invest direct in the Oaktree strategies offshore.
Okay, let's go. First question. Today, not actually today, but these times we're seeing the U.S. Treasury for 10 years getting a great volatility. And at the same time, we're watching S&P and other indexes from American stocks going up. The scenario is not real clear today, actually, in my opinion. What do you guys think about that? I mean, what's not actually the position of Oaktree, but in your minds, will the U.S. government be okay with that the curve that doesn't actually help with deficits and stuff? So are okay, or that's a real bad scenario?
You know, I think we're in a market right now where for the longest time you've had, if you look at futures curve for interest rates, for a while the market's been predicting we were going to have soft, or now they're saying no landing, and then after that you're going to have rates quickly go down. And that's been kind of the view of the market. And so you have this, you get into this good news is bad news is good news kind of market, because when their earnings are bad, that's good, because now the Fed's going to have to pivot. And we kind of laugh that, at Oaktree, we always say, look, bad news is bad news. Like, you're supposed to take that into account. But the market seems to be fairly resolute in its desire to see, a pivot. And so I think that's why when you see news come out where, hey, maybe we're done with rate hikes, you see the S&P do quite well. Now, for me, personally, I think it's much more likely, when you talk about rates, for whatever reason, to me, everyone's either talking about rates going dramatically up or dramatically down, but nobody talks about them just kind of staying where they are, which is the more logical outcome right now, I think, because you've got to remember the Fed has been very vocal. They have a 2% target. They're not there yet, but it's not to touch 2%, it's to hit 2% and stay at 2%. So if you get to 2%, you can't just quickly pivot and lower rates, because you're going to cause inflation to go back up. And so I think it's more likely, and something we've been talking about, Wayne and I, for over a year now, that you have to be prepared for rates to stay where they are, and have to make sure that the investments you make are in companies that can afford to pay for the debt if rates stay where they are.
Yeah, and I think it's been an interesting kind of almost push and pull between people who, believe kind of the bad news is good news kind of scenario, where I think you saw equities kind of rally on some of that. And then over the last maybe 3 weeks until this week, the markets realized, wait a minute, higher interest rates and a stronger economy is probably not good for equities. And what we've been saying would be clearly better for fixed income investors that are looking for yield. So I think that's going to be something that kind of keeps people occupied over the next few months, is that dynamic of very strong growth and reasonable inflation, to David's point, probably means rates at a minimum stay where they are, if not go a little bit higher. And that's tough for equities that need financing and need that cheaper cost of capital to kind of push that growth forward.
I have one question that normally I got a lot here in Brazil, is that regarding when the people think to invest abroad, normally the people think in equities. Why now they should think different, looking for fixed income? Because in the last 5 to 10 years, fixed income was not so exciting regarding returns and those type of things. It's a different scenario nowadays. Should people think about it?
over the last 5 years, there wasn't that much income in fixed income. Now the income is quite high, and I think it's really key. Our chairman, Howard Marks, wrote a memo called Sea Change, which really talks about how the world has changed now that you can earn double-digit yields out of credit. And I do actually firmly believe you're going to be in a period where debt is going to outperform equities. You think about it, equities, you generally need some element of growth. You need some growth, you put a multiple on that growth, you figure out your valuation. And as you point out, Bernardo, we've seen a lot of growth out of equities over the past 5 years because, at least in part, money was free. And when money's free, people borrow a lot. And when you borrow a lot, you can go build factories and you can go expand your business and you can have all this growth. Well, the very reason debt is attractive today is because money's expensive, which means that companies aren't going to be able to borrow as much, which means they're not going to have as much money to fund growth. And so it's the exact reason I think equities are going to be less attractive, because you're going to see less growth. The beauty with debt is we don't need growth. We just need to be able to pick companies that can generate enough cash to pay us back. And if they do, we get a double-digit return. And the funny thing is, you look back 5 years ago, most people bought equities with the hope of a 10% return. Now you can lock that in with debt and can get a contractual 10% return. And that's really key. I heard on a strategist on TV the other day who said it better than I can, but said, look, I like debt better than equities because if I buy debt today and nothing happens, I can get 10%. If I buy equities and nothing happens, I get nothing. And so that's really the key, is if you don't believe you're going to continue to see growth, and I can't imagine how you can believe that now that the cost of financing is so much higher, then debt is in a much better position.
I mean, one of the things we've been saying for the last year is that investing in fixed income, and certainly in global fixed income markets beyond government securities, bonds, and other assets, you can earn equity-like returns.
Yes.
And I think that's really true today, to David's point. When you can earn those contractual yields, those were the same expected returns that people had for equity markets. So we're certainly not saying there may not be some volatility along the way, but it's a pretty good proposition to lock in some of those rates versus live on a little bit more of the hope that equities can get through this environment.
It's good that you said global fixed income, because my question is, emerging markets, the fixed income is worth the risk? I mean, the risk, the premium risk is really worth? I mean, for a normal investor, picking up a Brazilian corporate bond from, I don't know, Vale or Itaú or companies like that, it is better to pick up these companies against, I don't know, Apple, Disney and stuff?
Well, I think I would think about it maybe a little bit different from our perspective. Is we are certainly global investors. We're looking at developed markets. We're looking at emerging markets. We're really looking at opportunity and kind of assessing different markets against each other. And I think one of the things that we've seen at this time, as we've gone through this, as David mentioned, this sea change, is that you've seen higher rates in developed markets. And that has put kind of yields in developed markets at levels where, to us, quite frankly, some of the opportunities in emerging markets just look relatively less attractive than they would have been, because we know we're buying, good quality companies in these very, very, very large markets. And so, again, not that you can't find good opportunities in emerging markets. For us, and maybe we just have a developed market bias to some degree, this kind of higher rate environment and higher yield environment has probably made developed markets a little bit relatively more attractive.
Yeah, it's the concept of risk-adjusted return, right? If all you're doing to get more return is taking more risk, there's no great bargain in that. But if you go back a couple of years, when fixed income was giving you, around 5%, the mantra in the market was very much, you got to take more risk to get more return. And taking more risk doesn't guarantee more return. It guarantees more volatility and the possibility of outcomes, right? And so I think today you're getting back to a point where risk-adjusted return is being more thoughtfully assessed, because you don't need to take crazy risk to get a good return. You can get a very good return out of developed markets. And so we still look opportunistically, and we'll find things in emerging markets that we really like. But you have to be getting paid a premium to the very healthy yield you're getting in the developed markets for it to make sense.
And I think you have to kind of think about the dynamic that's happened over the last, call it 18 months, where emerging markets, felt the pressure from inflation earlier than developed markets. They were raising interest rates way earlier than developed markets. And now developed markets have caught up, and emerging markets are starting to go the other way. I mean, Brazil is a perfectly good example where they raised rates very aggressively back up to near 14%. But now with your inflation falling down so low, your real rates, or the difference between your nominal and your inflation rate, is, I think, probably one of the highest in the world. And so there's a healthy expectation that those rates will come down, and those kind of 13% yields at the short end will not be able to be earned forever. And so as you kind of diversify maybe to some of these economies where you expect those rates to stay higher for potentially longer, is maybe one thing that's kind of pushing people into developed markets now as well.
I have one question, João, if you allow me. We had a situation in Brazil that we reached 2% interest rates not so long ago, and most of the investors in Brazil, they feel that they can buy corporate bonds because no risky, and now they go to 14, now it's going back again, but it's most of the credit in Brazil is floating. So the companies was familiar with 2, now they are paying 13%. And we start to see in the beginning of this year some credit problems in Brazil. How do you guys see this sea change, a new level of interest rates when you look for credit? Because my feeling is that some investor in Brazil, correct me if I'm wrong, João, say that no, I can buy everything in credit market, that everything will be fine, and we saw some problems in Brazil. How you guys are seeing this new level of interest rates for the credit risk, and how credit peak those companies?
You hit a great point, which is, people talk about floating rate debt. Rates are going up. We love floating rate debt. Rates go up, my yield goes up, I earn more money. People don't often talk about what that means to the credit. Rates go up, my interest burden goes up, my free cash flow goes down. So, at Oaktree, credit is core to everything that we do. We're always assessing credit. And the way I would put it is there are certain markets where credit analysis adds value, and there are certain markets where, frankly, it doesn't. Over the past 5 years or so, if you didn't do your credit analysis, it didn't always matter, because you had, in the U.S., we call the Fed put, and the central banks would bail you out, and you just had to not sell and buy stuff, and you would be fine. I firmly believe we're entering into a market now, because of the higher rates, where credit picking is going to be essential to survival, because there are companies that can afford this debt at a higher level. They borrowed money to improve their companies, and they're going to be fine. There are lots of companies that gorged on the debt because it was so cheap, and it turns out that when it becomes expensive, it's not so easy to refinance. And being able to differentiate those two, I believe, is going to separate those who do well from those who do not.
And I would add one thing too. If you think about, Bernardo, to your question, you're kind of getting to the point of how easy is it for companies to finance or pay the interest on their debt when rates are going up. And that interest coverage ratio basically becomes a multiple of your earnings divided by your interest expense. Well, certainly today, the denominator, the interest expense, has been going higher, pushing that down. And nobody seems to be panicking too much about that. Whereas if you think historically, the rate move today is maybe roughly equivalent to a 25% decline in earnings. If all your companies would have had a 25% decline in earnings, David, as a credit analyst, you would be freaking out and feeling bad. So it's interesting that they don't get looked at through that same lens, even though they have the same effect on the company.
That's it. So guys, I think we're going out of time, so I would like to thank you very much for being here with us today. Thank you, David. Thank you, Wayne.
Thanks for having us.
Yeah, thank you very much.
Sempre prazer estar com vocês.
Sure. Thank you, guys.